Well, hello and welcome to Finding Alpha. I'm Nigel D'Souza in the Mumbai News Center. Today on Finding Alpha, we decode the big shifts shaping India's consumption universe, the leadership transformations, intensifying competition, and sector cycles, all of them at play. The questions that we're asking: are the major headwinds easing for paints? Can Britannia maintain its momentum post Mr. Varun Berry? And is Titan ready to sparkle again despite competition? Joining us to break all of this down for us is Mihir Shah of Nomura. Well, Mihir, thanks a lot for coming down to the studio. Good to have you in person. And, before we get to discussing all those topics, congratulations on that big call on paints as well. Let's discuss all things consumption. Mihir, thanks for coming down.
Thank you, Nigel, and pleasure to be here.
Well, let's get straight then to the hot topic, paints, right? Now, at the start of November, you had this anti-consensus call. You went ahead and you upgraded both Asian Paints as well as Berger Paints. Could you tell us what were the key factors that led to this kind of shift in view, and what changed fundamentally in the industry or maybe on a company-wise data point? Tell us what made you take this bold call.
Absolutely. See, the paint sector was, going through some overhang, largely because of fear of competitive intensity, disrupting the growth profile and margin profile. This actually came into light after Bilaupus had actually highlighted a very significant large investment of 10,000 crores. Now, historically, there have been many other paint companies that have, forayed into paints, but such large capex was never announced. So it remained to be seen whether it will be impacting the sector or not.
Yeah.
So that was the key overhang the sector was facing. What we have realized over time, over the past 2 years since the launch, is going to be just a few months away from their second anniversary of launch. We saw that the disruption that was expected or there was fear, we saw, it was not materializing enough.
Yeah.
If you see the product prices, the product prices are very similar to the other legacy players. They were giving some introductory offer of 10%. If you see the dealer margins, again, a shade higher, but nothing significantly higher to cause any kind of disruption. If you see the impact on margins of Asian Paints or Berger Paints from their normative levels, they were just down about 200 basis points or 100 basis points during this phase of, launch and expansion that was there.
Right.
Growth profile, yes. In FY25, we saw growth for Asian and Berger actually to come down. But we believe it was not only because of competitive intensity, but was also a function of overall weakness that we were seeing in consumption.
In the industry.
So many other categories also were seeing weakness in consumption. So much so that Prime Minister Modi had to come and give some relief on GST across various other categories.
Indeed.
So it was not only a function of competitive intensity, but a culmination of many things. And also, if you recall what happened post-COVID in paints,
yeah,
the organized paint players saw significantly higher volume growth. They were, taking share from the unorganized guys. And we believe that there was some amount of preponement of paints that also happened during that phase. Folks were sitting at home.
Yeah, they wanted to.
It is a, it is a budgeted activity, both time-wise and money-wise. And hence, there was some preponement which led to this impact on sales. We believe that, so that was, part one. The other thing that we started, when we did our surveys with the dealers and distributors, we realized that the parabolic growth that the competition or the new entrants were seeing, that has started to moderate down.
Okay.
They've come to more normalized levels. Maybe a function of they've already reached about 50,000 dealers that they were targeting to reach in 3 years. The 10,000 crores of capex that they had wanted to invest is kind of almost exhausted completely now. So going forward, we realized, and some of the dealers were lost to the new entrants were started to coming back. So we realized disruption is not materializing. Having said that, from here on, growth is going to be, or competitive intensity is going to be more normal rather than disruptive. And our call was that if after putting in such a significant amount of money, if it has not derailed the legacy players, then why penalize them?
Got it. All right. Got it. And that's an important point you're making. You're saying competitive intensity will remain healthy, but it will not remain disruptive, as was feared earlier. Let's talk about the big conglomerate that did come in then. Birla Opus. Well, they've already deployed the initial capital, as you said. But given the group size, the concern could be whether they will double down on the investments and put in more money. If the Aditya Birla Group decides to come in there and pump in more money, do you think it'll add some kind of fuel to this disruption fire? Or do you think, no, they're pretty much done with this 10,000 crores odd?
No, you're absolutely right. I mean, while upgrading, we did think of this scenario, other scenarios like maybe another superstar CEO can again join them.
Yeah.
There are various many scenarios. But our call is not about competitive intensity, our call is about disruption no longer being there. I'll take a leaf from historical examples. If you remember what happened to Jubilant FoodWorks margins when Zomato, Swiggy, food aggregators were coming about 7-8 years back, margins were like completely halved. If you remember what happened to Lever's margins during Lever P&G detergent price war back in 2003, margins were half. We've not seen any of the disruption thus far. We believe that there are very strong moats that these legacy players have, and they will continue to, play these moats and defend their share. Of course, competitive intensity, we are not calling out that it will completely go away. It will remain healthy, it will remain high. But will it cause disruption? Not as much.
Okay, all right. Valid points then out there. You were saying that the big conglomerate came in there, didn't really shake things up to the extent that the street was fearing. Maybe some compression on margins, maybe growth slowed down, but that was more an industry phenomena rather than the disruptor that's coming in there. Now, since your big call that you made on paints, in early November, Asian Paints is up, what, 17% or thereabouts. You have Berger as well that's up close to around 8%. Now, backed by strong quarterly performance, does Asian Paints still have legs from year on? Do you think, it can still move up, even Berger Paints? And to borrow a line from, your note that I saw, ain't no mountain high enough. Is there more altitude left in this sort of a rally that we've seen?
No, we do think that there is more legs to the room, simply because very rarely you see, all the three tailwinds coming together. The tailwind of a probability of volume seeing an improvement, a tailwind of margin seeing an improvement, a tailwind of PE re-rating that is likely to happen.
Yes.
And like I said, we still expect competitive intensity to remain high. The recent results that we saw for Asian Paints were ahead of estimates from, by our estimates and also from the street estimates. Volumes came back to double digits. That was not expected. In a weak quarter, in a monsoon quarter, they expanded their margins by 240 odd basis points. That was not expected. We believe that the steps that the company has been taking over the past 3, 6, 9 months has started to yield results, and going forward they can probably maintain this kind of trajectory. We have built those in our numbers. We believe that in a weak quarter when they've done these kind of margins, in the second half we are expecting margins to go up as about 19-20%, which is at the higher end of their band. Now, over the next 2 years, we are still forecasting margins to stay close to around 19 odd levels. We're not, taking it, further higher. Which means that as we saw a surprise in the first quarter, if there are more dots, they will make a line, they will make a trend. And then probably you will see that, like how we, became constructive. If you see most of the street still is on the negative side or has a sell rating, there'll be more people who will get constructed. We will have to bake in more fundamental improvement than what we have already baked in right now. And hence there will be more legs to the stocks.
All right, and the official rating as well as target price up for our viewers on the screen that Mihir has. Well, Mihir, the industry has moved from one disruption to another. Let's talk about the jewelry space. Is the threat from lab-grown diamonds now meaningfully behind us? Or is that still a bit of an overhang for the jewelry ecosystem? Because paints is done. What about jewelry sector? This, lab-grown demand suddenly had derailed it in the middle. Then some of these players have adapted to it. So what's your take?
You're absolutely right. There was a lot of disruption in the past couple of years across various subcategories in consumption. In jewelry, while the curiosity around lab-grown still remains, the adoption is still, getting along. We believe that if you see, there is very little evidence that it has impacted the industry,
Okay.
Indian jewelry industry, or for that matter, Titan's studded sales as well. If you just see over the past 12 quarters, Titan's studded growth has been about 19% CAGR. In the peak of LGD euphoria, if you see some Google searches on trends on how lab grown is getting searched, the search rates have actually started to come off a bit. The prices of lab grown have continuously corrected, and that is again there's a lot of question mark around where will it settle down.
Yes.
Again, the resale value for lab grown is not there.
So,
The reason why Titan grew its studded jewelry by 19% and did not get disrupted is largely because of small diamonds. So lab grown actually impacted the prices of solitaire, which is 1 carat and above diamonds globally. And because of the prices of solitaires went down, the demand went down, and they were impacting them.
right.
But the prices for small diamonds, which the Indians wear in their jewelry, that did not see any impact.
Got it.
And that is why we have not seen any evidence that lab-grown is substituting the studded jewelry for Titan, or it is impacting the growth profile. More so, if you see for Titan specifically, studded jewelry is 30% of sales. Within that 30%, solitaires are just about 15%,
Okay.
which essentially means
5%, less
only
than-
5% is what exposure the Titan has to lab-grown's disruption.
Okay. All right. Just to take that argument forward, within the jewelry space, Titan has been the so-called Hira, because that's always been, shining bright. While peers, they have sparkle, but only in phases. Some of them have sparkle, and then they have just, fallen by the wayside. Now, despite this 20% run that we have seen in Titan, in the last 1 year, actually in the last 2 years, the stock has virtually been unmoved. Do you think that this consolidation that we've seen on Titan is setting it up for better times? And also a quick comment, people sometimes argue Titan at 60 times expensive. What do you have to say to that? Such a rank outperformer.
No, you're absolutely right. I mean, the reason why this stock was around flattish for 2.5 years, before the move that we saw, a month ago, was getting impacted because of the lab grown, because of higher competitive intensity that was feared. A lot of new regional players were coming about, hitting, tapping the public market money, expanding stores. There was some pressure on margins because of that, because of higher competitive intensity. Now with the margins kind of resetting is base for Titan, and more clarity that lab-grown is not disrupting, we started to see things again moving. Even the high gold prices was feared that optically the gold prices are crossing a lakh rupees.
Now prices have cooled off a little bit. That will help demand, I'm guessing.
Correct. Footfalls have started to come back. So there was a lot of headwinds or feared headwinds that was there. While Titan was holding up, there was little evidence that it will continue to keep its momentum high or not. We believe all these things are behind. More so, we've put out in our report also, we see Titan as, it was forged under pressure. When the existence of Titan came in, came in an industry where it was completely unorganized.
Industry was fragmented, margins were low.
Absolutely
and
right.
They made their entry.
And they made their entry. More importantly, if you see right now, the organized industry is just about 40%. Versus if you see most of the other consumption categories, they have a significantly higher organized share.
Yes.
So there is more room for growth. And Titan also has very significant moats. They have very strong customer acquisition tools like Golden Harvest, Gold Exchange schemes. These are all installments-based schemes. And people are comfortable to give their money in installments to Titan rather than to probably a Mihir Shah and jewelers. They won't be as comfortable to give it to somebody like that. So I would say that they have these strong tools.
Yeah.
They are having the highest trust value, given they are completely transparent. Their corporate governance are high.
Right.
And the cohort of consumer that they attract is, at the premium and a higher end of the consumer, which have the propensity to, buy 1.5 to 2 times more than what the GDP growth is.
Got it. So you're bullish on Titan's prospects from here on. That challenge with regard to lab grown wasn't such a big challenge for them, but that as well is moving aside. And now the company is posted for better times, and the target price comes up for our viewers on the screen as well. Let's talk about a biscuit, Britannia. The transformation of the last few years has been super. That was under the leadership of Mr. Varun Berry. Now, as we know, he's moved on. So in the post-Berry phase, what gives you confidence that this sort of a momentum in growth can be maintained, the innovation that we saw, the sustainability of the business as well? Because you're fairly positive, and the multiple you're giving actually is a premium than what we have seen in the last 10 years or so. So explain that bullish call on Britannia post Mr. Berry.
No, you're absolutely right. I mean, difficult question. We upgraded Britannia in August after the 1Q results because we saw that Britannia is in a sweet spot. It will also post the GST. It will be one of the key beneficiaries of the GST reduction that is there. 65% of its products are at 5 and 10 rupee price points, which means that technically they will do much better as GST actually addresses the 65% of the bottom of the pyramid households in India, where we had seen titrating of consumption happening because inflation was high and wage growth was low. So the relief will come there. So category like biscuits, will probably see one of the key beneficiaries. You're right. I mean, Mr. Berry did transform. When he took over from Britannia, I think margins were about 13 years back. They were close to like about 5%.
5-6%, yeah.
He brought it way back to like 15 to 18,
19%.
closer to 19% now. So he's done a phenomenal job on margin improvement, cost. Coming from Pepsi, he had very strict eye on the cost efficiencies, etc. He brought back volume growth. There's a continuous direct distribution increase that the company is doing, especially in the Hindi heartland where they are under-indexed in their market share versus the overall pan-India index. So phenomenal, work there. Post him, yes, with Rakshit coming in, I think he's also having a very decent track record, very worthy successor in my view. We believe that the journey to a total foods company kind of has is still not yet complete.
Okay.
And we believe that the team, the second-tier management that Britannia has under Varun Berry's leadership, he's pretty strong.
Yes.
They have identified the white spaces, which categories to grow, how to grow. I think they can take over well, from Mr. Berry.
So Britannia's biscuit could remain crispy enough for your liking, and Mr. Rakshit, well, he comes on board and he's as good as any other successor in the business as well. Well, Mihir, we're questioning you just to stay with us. We're going to take a small break, come back. We'll continue focusing on the other FMCG companies. Stay tuned. Welcome back. You're still tuned into Finding Alpha, and we've got Mihir Shah of Nomura, who's with us discussing the entire consumption theme. We've got a couple of queries actually that have come in. Raghav Iyer writes to us from Hyderabad. He holds around 100 shares of HUL at 2,710 rupees since September 2021. Oh boy. He wants to know the future prospects of the stock. What do you think, Mihir? Time for HUL to show up?
Yeah, Nigel, we have a buy rating, and we believe that HUL was ripe for improvement. But with the GST destocking, because the announcement and the implementation had some time, and because of which there was a trade destocking that played through. So the volume growth did not come in as expected. More importantly, the restocking is not going to happen in the same way the destocking happened.
Right.
So the restocking, will probably happen over time and over quarters. So we believe that the improvement, while it is likely, it will be a gradual one. So second half will be better than first. Also, with the management change that has happened with Priya Nair taking over, we believe there'll be a lot of new energy into the company, and we are expecting things to get better faster. Plus, given it has the premium end of the portfolio for Lever continues to do well. Given it has a very significant large company and addresses a very large mass market consumption, is where the inflation, like we highlighted in the earlier section, that inflation was high, incomes were low, that was impacting the consumption there, and people were titrating there. We believe that also it takes time as macro comes in place.
So you think, from here on, the stock could actually do well? There are better times ahead for HUL, given the kind of, and quarter two was hit by GST and various other factors. but gradually things will start improving for HUL. Is that correct?
Yes, improvement is likely, but it will be a gradual one.
Gradual.
It will not be a quick one.
Since you mentioned GST, now I want to ask you about Colgate. That's seen as one of the key beneficiaries, right, of GST 2.0. The stock is already down, 40% from the peak. Yet the earnings delivery hasn't really come about. How should investors approach a stock like Colgate, 40% down on a blue chip name like Colgate?
Yeah. No, yeah, we have a reduced rating on Colgate. We believe that they are not yet completely out of the woods. Before GST, we thought that, yes, probably now things might start turning for them. But again, because of the deferment of this, we still think that the improvement on the volume growth will take a couple of more quarters.
Yeah.
More importantly, there's an inverse duty structure that will put some additional pressure on their margins, and hence their margins also be under pressure for some time. Till all these things resettle, maybe it'll be a couple of more quarters.
So headwinds persist.
Some more headwinds for some more time. Post this, we will revisit our call on the stock.
Okay, all right. Let's squeeze in a couple of more queries. We have Umesh Nair, who writes to us from Kerala. He holds around 630 shares of Godrej Consumer at around 722 odd. Long-term investor wants to know what's the long-term outlook on the stock. Actually, these numbers look good, right, from Godrej Consumer. They did that inorganic growth as well, and you all have been fairly positive on the stock. What's the view?
Yeah, no, Godrej has been one of our top picks. We believe that worst is kind of over for Godrej. They were facing a lot of headwinds on the margins because of high palm oil prices. Volumes were pretty decent any which way. But we believe that as palm oils prices have started to moderate down, from next quarter onwards, you'll see a sharp uptick in the India margins. 2Q India margins are close to around 21%. We are expecting them to go to around 23.5%, 24% in a quarter's time because of the lower palm oil prices. So I think the worst is behind, now, and we are expecting improvement on Godrej from here on, both on the volume front and on the margin front. The other thing on Godrej is that if you see the past couple of years since Mr. Sudhir Sitapati has taken over, they are entering into one or two new categories, increasing the total addressable market, getting into categories which are of the future, which are having a higher growth rate profile. We believe that with the medium term, you will see a very different Godrej portfolio versus what you see now versus the next couple of years. And if the critical mass is got within those newer future brands, the growth profile again will be significantly ahead of peers. So for us, Godrej is a longer term call, getting into newer categories, increasing their total addressable market, doing well on the core, and growing well. So yeah.
Okay, all right, Mihir. It's been a pleasure having you on the show. Thank you for taking us through all those aspects. As you said, the big disruption in paints didn't really take about. From the jewellery sector, you like the big boy, the Hira, so to call it, Titan. And Britannia could do well, even post Mr. Berry's exit. And from the other stocks that we discussed, Colgate is a stock that could struggle in the near term, while we have tailwinds that are in the offing for HUL as well as Godrej Consumer. And I think Marico as well, you have a positive call. Thanks a lot for joining in, giving us your take on the consumption space. We look forward to having you on the show yet again. Well, that's all we have on this edition of Finding Alpha. Thanks a lot for watching.